This is why a lot of VC firms don't have like 100% like their investment committee. They don't require 100% of votes in favor for. They only require like the majority or whatever, because like you should have dissenters. If you're really doing something revolutionary, you should have dissenters. Like trying to get consensus is just stupid, I think, especially in innovation. But what separates in my experience, what separates the exceptional founders from the average is that whilst they don't like raising capital, they enjoy the psychology and the pattern identification of it.
Dive into the intriguing world of deep technology and its intersection with business on Technocracy. We're your hosts, Ajay and Loon. Let's explore the breakthroughs and people shaping the future of technology. Technocracy Podcast.
If you're tuning in today, we're going to be talking about fundraising. As you can probably tell, my co-host is not bald and is not half Asian. So I've got Warwick today. And we're bringing him into the big leagues today because he's usually like working on much smaller stuff. And, you know, one of his goals for 2024 was to be on a podcast with 30 listeners. So I thought, let's bring him into the big leagues.
You told me that he's got thousands of listeners, you motherfucker.
So he's been on the fundraising side, on both sides actually. So he's been on the venture capital side. He's done other kinds of fundraising as well. And then also helped a lot of founders go through the fundraising journey as well. And then on my side, I've been a founder, went through fundraising a few times. And then I've also invested as an angel and will probably lose all that money. If I'm not going to, I just don't think the investments are going to pan out, if I'm being completely honest, but we'll see. Maybe in 10 years, we'll see what the fund portfolio looks like after 30 or 40 different investments. Today, I'm going to be going over some hot takes on fundraising.
Can we talk about? Can you talk about why? Why you think? What did you learn from your investments? Like, why do you think they're not going to perform?
So, I think.
By the way, I have ADHD, so we're going to go on tangents like all day, every day. So
this works well. So I think the first 5 or 6, I think we just didn't have the right investment philosophy. Like we weren't looking for the right things. So for those who are familiar, I invest with Caleb. So we sort of shared deal flow and sort of decide together. I think the first few, we just weren't thinking about it too seriously. We were just sort of investing in friends and family and like people we kind of knew and like kind of trusted.
I remember those.
And then we started putting a bit more of a lens into the investment side of things and focus on the product and the velocity of founders. And I think the last 5 investments we made were pretty good. So will they carry the entire fund? Maybe. Like we just have to see what happens.
What makes them good?
I think the problem was a little bit more vast in like the way they were being approached. So like fundamental problems such as transport in Africa or the gig economy and like things where we actually saw like glaring gaps in the market. And then we found a founder that like had deep expertise. And what was really interesting in Africa especially is like, you know, Australian founders, they spend 6 months looking at something and they're like, cool, I can tackle this space. And I think that like blissful ignorance and confidence is actually really good. However, in Africa, you have people who are like 10, 15 years deep expertise in that field and are like, yeah, I know exactly what to do. Like if you give me the money, I know exactly what the game plan is going to look like and how we're going to sort of transform things. So it felt a little bit more assured. But I think we're looking at like 10 to 40x opportunities rather than 100 to 1000x opportunities. Like, what are they called? Like dragons, not unicorns, essentially. Yeah.
Interesting. How instrumental do you think that the founder selection was in the process?
Yeah, I think extremely. Like we had a few founders that just weren't the right founders. I think after we did a bit more due diligence and sort of worked with them a bit more closely. To put it in perspective, one of the founders, I wouldn't say who, but one of them stole $2 million from the company and just like pieced out. And the company is now currently under litigation to get that money back. And this is a founder we thought was pretty good. Like, Caleb's talked to him a few times and like, you know, we thought he came off trustworthy and like, usually you're only doing like 2 or 3 meetings with a founder before making a judgment call on whether they're like the right fit. And so this just blew my mind that like, yeah, like how do you get more conviction on a founder besides, I guess, like watching them for 6 to 12 months building the company from pre-seed to seed and then deciding on that line as opposed to oh, let's do a few meetings and make a judgment call immediately.
Yeah.
So it's a bit tricky. Yeah.
What are the characteristics of a great and exceptional founder, do you think?
Okay, I want to hear your thoughts on this as well. But I think to me, it's high velocity, high capability to learn new skill sets. So generally, if they weren't a coder and like learn how to code to build this thing, amazing. If they learned growth marketing to do this thing, amazing. Like the velocity of growth and movement, I think is really important. And then the other one is like just like resilience, right? Being able to like get up after falling down over and over and over again, which like I think is a pretty underrated ability for a lot of founders, right? So I know those are vague answers, but those are the high level. Sure. What about you?
I've done so much work on this recently, and actually for the last however many years. So I founded my first tech company in 2014. I started my first business when I was 7. And my first tech company failed because I didn't want to do the work. I just wanted to build something. And then I built the thing, and then I turned it on and nobody came. And I was like, what the fuck's going on? And then someone's like, well, you need to go and sell it. You need to get people in. Just because you have a website and a product doesn't mean anyone's going to turn up. I was like, I don't fucking want to do that. And it was a fitness marketplace, and I didn't give a shit about fitness at the time. And then someone's like, well, you need to go and talk to people and get them on and convince them. I was like, I don't want to do that. And so then I just shut it down. And I was like, it's not what I signed up for. And so that was the first important lesson. And luckily it only cost $10,000 and, you know, like 12 months of my time or something. And that was a very important lesson. It was far cheaper than doing an MBA, as many people have told me. And then I've started a few other businesses since, and I could never really, my risk appetite was not large enough to take the step to go all in. But over the years, I've met thousands of founders and reviewed thousands of pitch decks. And I know some founders that are very successful, and I'm actually lucky that all the businesses that I've worked in, all the tech companies that I've worked in are still alive today, and some of them are quite large and growing. And you know, I get to be there as like one of the first employees, and I still get to follow their journeys now, and I know a lot of the stuff on the inside, and I get to see some of the things that make it tick, and some of the things that were decisions we made, you know, years ago, and now how they're manifesting and these sorts of things, and so I get to experience why the founder is so important, because there are so many things that could kill your company at all the time, and the majority of them are so outside of like the founder's control or anybody's control, like the economic environment, you know, like relationships and like all this sort of stuff. If you have an employee that steals a shitload of money and like all these things, like some of them are manageable risks and some of them are just macro and that you have no control over. And so if maybe 90% of the things that could kill you are out of your control, then what are some of the things that are within the control of investors? And the most influential one is the founder, right? And I think that's why there's so much importance that's placed on the founder, especially in the pre-seed to kind of Series A stage, or pre-seed and seed especially. And I've seen this year, I've seen exceptional founders that I've worked with get invested in that don't have all the ducks in the row as you'd expect with other businesses, but because they're exceptional founders, investors look past that. Their financial model's nothing special or whatever, right? And the investors like work with them to get that stuff in shape before they invest in them usually, or they don't think it's important because it's so important to have that exceptional founder. And so I've started to identify more and more, and you know, what some of these characteristics are. And the problem is that all these characteristics are qualitative, and there's no way to like quantify them. And the worst bit is that any founder who's like reflecting on any of these characteristics it's very hard for them to judge themselves. And this is what drives so much of the pain, because it's like, do I have grit? Yeah, I have grit. I've seen some shit in my life, and I'm still here, and like, things are good, right? Like, yeah, I have grit, and that's like a relative thing, right? And it's very hard to quantify this. And I think this drives a lot of the confusion and pain in the industry. But so these are some of the things, and I actually just spent the last couple of days jotting down some of these characteristics. And all right, where are they? Just going to bring them up.
While you bring that up, like one of the things, like you hit the nail on the head with the whole like decision-making process for investing in like pre-seed, because one of the things I did recently was do some of the interviews for StartMate and sort of help decide or give my recommendation on companies. And one of the things I sort of brought up to some of the other judges was that, they were sort of bringing up like valuations and whether the economics make sense and all this stuff. And I sort of said, like, guys, I think if we think that this is the product they're going to launch with in 3 months, it's like highly unlikely.
Yes.
Like realistically, what we're looking for is like, is the founder awesome? And is the opportunity in space awesome? And does that multiply into something even more awesome, right? So 9 out of 10 founder, 9 out of 10 opportunity, that's an 81% to me. Like that's what we're looking for. And it's a very simple equation. Yeah. But it's a lot of art and science, and it's not quite like, there's no numbers and economics, which like I think makes a lot of people hesitant, especially if they come from stock investing or something, right?
And that breeds the perfect environment for biases to creep in, because if there's the fundamental thing that people believe that you need to assess people on to make a decision on a good investment is something qualitative and not really objectionably accessible, then your biases are just rife, and like it's very hard to like go beyond that and get outside of that. That's the big problem that the industry faces and will continue to face for a very long time. I don't think there's any way to really to get beyond that in a quick way. All right, so some of the things that I've got is they need to be inspiring. So they need to be a leader. They need to be a great speaker, and they need to be motivational. They need to be able to lead customers, investors, employees, the media, suppliers. They need to be able to get all of these people on board with your vision and why backing you when it doesn't make sense, when it's highly risky, is a thing that you should be doing, right? And so you need to be inspiring and a great speaker, and you need to be able to be vulnerable and have a vision for the world that people get behind. Like that's Sam Altman, right? Like I've listened to so much of Sam's stuff in the last couple of weeks. And again, he makes claims about what he thinks the world is going to be in the next 10 years. And that gets people excited. But these are not like small visions of like, like we're going to change the world and blah, blah, blah. He's like, no, like we're going to revolutionize the world. We're going to upend society and the way society operates. And like, this is stuff that like is emotive, right? This gets people riled up. And people want to back people who aren't afraid to be vulnerable and stake their claim about the future and say you're either on or you're on board or you're not. But this ship is leaving and like, I don't really care. That's what I get out of Sam and the other founders that I see, that I get inspired by.
So not to toot my own horn here, but I think the reason why entry level raised, even though we were just a courses business, right? Like fundamentally we just sell courses, and there's so many other companies that do that. But I think the vision that we sort of pitched that was that we're going to reskill 1 billion people by 2030 for under $2 per person. Yeah. And there's a huge issue with the cost of reskilling, and we're just like automating everything. We've just reskilled 10,000 people in one cohort in 1 month for under $2 per person. Yeah. Here's how we're doing it. Yeah. And just like that reframe suddenly turns our valuation from like $0 to like 12 or 20 million, right? Like
Yeah, definitely.
it's wild, but it makes a big difference. You're totally right.
And what I see most of the time is I see what I call investor pleasing. I see mediocrity where founders are hiding what they really want and are trying to tell investors what they think they want to hear, and they think that they want to hear something that's believable. But the truth is like, I think that Australian investors are not risk adverse. I think that Australian investors invest in high risk, visionary founders that have a dream about the world that's transformational. I think they're allergic to mediocrity. And I think that most founders are selling a mediocre dream. And that's like a controversial take, but it's so like based on what I see all day, every day. It's like I hear some of this stuff and they're like, oh, I can't make any guarantees about the future and I don't want to make a claim and I don't have the evidence. It's like, okay, well, no one's going to follow you then. Like if you don't have confidence, then who else is going to have confidence in you, right?
Dude, you stole one of my hot takes. I literally wrote, Australian investors are not conservative. Australian founders are just mediocre. So, same page.
There you go. It's
if you're listening to this, you're most likely in Australia, and I hate to break it to you, but it's probably the case. And I think there's this also. If you're an Australian founder and you're young, like go to Singapore, Dubai, San Francisco, and see how the game is played, and you're just like, you realize like playing tennis in Wimbledon versus like your local competition, you're gonna get better. Like you're just gonna feel the difference. So
go to China and see, like, just blow your mind apart, like just how nothing is what you thought. And but it's so true, right? And there are a lot of really good investors in Australia that do invest in really, really high end stuff. But there are also a lot of investors that don't invest in that, and the majority of investors don't invest in high risk stuff. But they generally don't invest in the tech industry because they're conservative investors, and that's fine. But yeah, it's don't try to generalize all tech investors because of your bad experience.
Yeah, 100%. Do you have any other thoughts on founders, or should
I have lots? Yeah.
Give you my okay. Let's go. Let's keep going through the founder stuff.
They're impatient. They're
as you can probably tell, I just loaded up the slides before you stopped talking.
You're impatient as fuck. Like, hurry the fuck up. I want to say things now. So they're impatient and they're experimental and they have a growth mindset and they're curious and they're disciplined, and they have a drive to win and they're able to handle rejection. Or they learn to handle rejection. The truth is that if you're doing something really novel and like revolutionary, then the majority of people should not accept it and come along for the journey. And by having the desire to try to get everybody to give you permission and accept what you're saying and get excited by it, it means that you have to be mediocre, because most people want comfort and most people want incremental change. And so you shouldn't be trying to please every investor because they say no and they can't see the future you want. You want to just find the investors that see what you see. You don't want to fight every investor and try to convince everybody. It's just tiring. Just move fast and find the ones that see the world the way that you see it and get them on board and then just keep moving.
To your point, and bringing it back to start, mate, the companies I find the most interesting are not the ones that all have a hell yes to like get into the accelerator. It's the ones that have very high polarity. Like there are half the people that are super bullish and half the people hate it. That's why I'm like, okay, I need to pay attention to this company because there's something really weird about it, right?
Yeah, and so this is why a lot of VC firms don't have like 100% on their investment committee. They don't require 100% of votes in favor for. They only require like the majority or whatever, because like you should have dissenters. If you're really doing something revolutionary, you should have dissenters. And it's the same as like politics and stuff, right? Like trying to get consensus is just stupid. I think, especially in innovation. And one of the last ones that I've identified recently, and there's a whole heap more, but one that I want to point out is like, in my experience, I've never met a founder that enjoys raising capital. But what separates in my experience, what separates the exceptional founders from the average is that whilst they don't like raising capital, they enjoy the psychology and the pattern identification of it. They enjoy talking to investors and finding the patterns and observing them and treating it like a big game that needs to be played. And that's how they get the joy. That's how they get it done, because they find some value in it. Whereas the other ones, they get caught up in the rejection and the fact that people are saying no and everybody needs to say yes and I need permission and all this stuff. And I just hate raising. I just want to like build product, and that way you just end up as like a negative Nancy, and it becomes really, really hard to like execute, because you're probably gonna have to talk to hundreds of investors. And if you're talking to hundreds of investors and you can't see any value in it, then like that's a hard slog and you're gonna burn out from that. So the best investors founders I work with usually find they enjoy it and they find ways to enjoy it.
I think the build it and they will come to you mantra applies to investors, right? Like,
yes,
if you build something interesting, they'll all find you. They'll find a way.
Yeah. So yeah, and this is another thing that I've been working on recently. It's like, do I train companies on how to raise capital, or do I train founders on how to be exceptional and build the best companies that are performing at the highest level that then attract investors because they are top tier? And it's a more roundabout way, but it's a much more rounded, much more long-term, sustainable way of capital raising. And to be an exceptional founder, you need to have extremely good mental health and physical health, but also EQ. You need to be a leader. You need to be able to inspire, tell stories, speak in public, convince people or get people to come along on your journey, these sorts of things. And that's what investors invest in, right? So, yeah.
Nice. Okay. Let's go through some of my hot takes. The reason why I wanted you on this podcast, and specifically your feedback, is because I have a very shallow perspective on this based on my own experience. You've literally looked at hundreds of data points and have been staring at this for 4 years, 5 years, maybe more. First hand, second hand, like I think you've looked at it more than most Australians in this country. So this is why I want your perspective on it. And if you're a founder listening to this podcast, you're going to get a very heavy data set sort of background to some of this like high level nuance, essentially. Okay. Maybe bring your mic a little bit closer to your mouth, because I think it was a little bit soft. Yeah.
You're soft. Is that better?
Yeah, I would appreciate the, being a bit kinder, but that's fine.
Oh, I'm sorry, mate. You look really nice today.
I just think that we haven't hit that point in our relationship. Where... Okay, so here are my hot takes. Some of it we may have already talked about. I can't even remember what I wrote down now, but we'll just flick through them. Number one, asking a pre-seed founder for financial projections is a rookie move. Thoughts?
No, I don't agree with that.
Okay.
You should be asking for financial projections. It's the question of what you're expecting within those financial projections. I think that is the nuance here. And to be perfectly honest, like what I'm going to tell you is part experience, because I was the head of finance and operations for a scaling tech company. And I've spent my career as a financial analyst and have done accounting and finance and all that sort of stuff for a very long time. But also part of just from what I observe from what investors say, as well as what I've seen this year has gotten across the line. I've seen really good founders this year get funded without really any decent financial projections, because the investors are just so much more concerned about whether they're a good founder or not, and they're confident that they'll figure these bits and pieces out. But asking for a financial projections to get some certainty about the future is wrong. The only thing that I think anybody can guarantee about a financial forecast, or any forecast in general, predicting the future, is that you're almost certainly going to be wrong, and that nobody can reliably predict the future. Even like listed companies with billions of dollars that have teams of people who specialize in financial forecasting get this wrong regularly. So it is incredibly hard. So it's not about the numbers and relying on the numbers. It's more about understanding, one, that you have a financial forecast and you know how to put it together, and you have some way of measuring your cash burn, but also like, you know, what's coming up, and so you have some decision-making process around allocating the funds, and tracking historical, so you can learn and iterate. But also it's about understanding how you're assessing this business, and what the inputs are to the business, what the key assumptions behind the business are, what you need when, how much capital you're going to consume over a period of time, where you think this is going to be in 3 years or 5 years or whatever. And I definitely don't think you should probably be doing a 5-year forecast, because at the end of the day, everyone just ends up doing like times 0.1 previous sell, and times 1.1 previous sell, and just like and just putting out 5 years, and that's kind of useless, right? So yeah, it's really about understanding those inputs and assumptions, and what you think the drivers of success are going to be, and how you monitor and track and manage your cash.
Okay, so
Thoughts?
I'm glad you took the opposite position here. So from my perspective, if you're raising pre-seed, you're either pre-revenue or just have something that's just started working. Maybe you're making a few thousand, tens of thousands of dollars, and you're very early in the journey. I can see the need for a unit economic slide, and sort of explaining like, yep, this is how we make our margin, this is how much it costs us per unit, like this is our rough thinking around pricing, which may evolve over time. But for you to project even 12 months into the future with like very little data, like 1 to 3 months of data, or you've just started monetizing, I just think that it's like you're making so many assumptions that it's not even useful to even look at that. Like, why would an investor look at that and be like, cool, it's very useful for me to understand they've assumed a 30% month-to-month growth as opposed to 50%. Like, it just sounds so...
I'll tell you the
truth.
truth.
To me, it doesn't sound that useful.
It's because they want to know that you're thinking about these things. What happens if they give you $1 million today, and then in 4 months you run out of money, and you're like, oh, whoops, sorry. Like, yeah, I guess we should have been tracking our consumption and doing a little bit of forecasting, right? We didn't even have anything.
Right,
that's
so
what it's
you're
trying to
thinking
avoid.
more like runway and things like that. As
Correct.
Okay.
It's about, how do you think about this business? How do you think about this business in the short term, in the medium term, and then how are you managing your runway? And do you even have any mechanisms to do that? Because I don't want to give you money today, and then in 4 months you run out of money, and you go, oh well, whoops. That's not acceptable. Even in a very high risk pre-seed company, that's not acceptable.
Okay. I will amend this. I think you make a good point. I'm going to amend it to revenue projections, right? Like, it's probably like not the most useful thing if you're pre-seed. I think runway projections is useful to understand how you're going to spend the money.
But you need revenue projections to do runway projections. Are you a financial person, AJ?
I like dabbling with my budget spreadsheet and my revenue projection spreadsheet now, because I've got 3 to 4 years of data of like, and I can kind of know how the levers are going to move. But I know that, like, for example, when I raised pre-seed and even seed, we were pre-revenue. I didn't know how we were going to monetize, and I was pretty upfront about that. And I said, like, here are 4 ideas on how we might monetize, but we have no monetization model.
Yep.
Why would I wouldn't do a financial projection for that, right? Like, and when people ask me, I said, like, I can make a spreadsheet and draw a line that goes from bottom left to top right if you really want me to, but I don't see how that's going to help you. And most of them are like, cool, that's fine. Actually, only one of them even asked me, like one potential investor asked me, and I did think it was kind of silly, like, if I was being honest.
And so that's interesting in and of itself, right? So that just goes to show that they invested in you as an exceptional founder rather than the business and the business today. And that just goes back to what most founders find so frustrating and hard to understand is how you can get money when you don't have all of this stuff in order, when they can't and they have spent months doing all of this stuff. And it comes back to this idea again that when investors, early stage investors, find exceptional founders, they're willing to look past this stuff today because they think that you're going to work it out in the future.
Okay, so I think the caveat here is whether you're pre or post revenue and whether you have enough data and levers to work with to make these projections. Okay.
Yep.
Fair enough. I think I was sort of coming into the perspective of that most pre-seed founders are pre-revenue or literally have just figured out monetization 1 to 3 months ago, and I'm like kind of coming into the conversation like that. And so when people are asking, like even the accelerator sort of discussions, like most of the companies coming to the accelerators are like pre-revenue or just monetized like a month ago.
Yeah.
And like maybe have like a couple of $100 here and there. So when they have a revenue projection slide, it just makes me think, oh, they don't know what they're doing. Like I judge them, if I'm being honest.
Well, I work with a lot of deep tech companies who are years away from having revenue. And so it's not really about forecasting revenue, but it's about understanding your cash burn. And actually, a lot of them have a lot of grant money. And to get grant money, you need to have proper sound financial management because you're being given money, your custodians of money that comes from the taxpayer usually, and so therefore you need to be responsible with it, which is a completely acceptable thing to ask for. And so to get decent grant money, you usually have to have at least some basic level of cash management.
Okay, great.
Which is fair.
Yeah. I'm glad you're here. You've changed my mind a little bit on this, which is useful. You've evolved my thinking. All right, so number 2, not all money is created equal. Taking capital from the wrong investor can be worse than going without. What do you think?
Definitely. Yeah, but this is easy to say when when you're not faced with this conundrum yourself, right? It's easy to say, if I'm hungry, if I'm starving, would I steal some food from someone, or would I stick to my values, right? And it's very easy.
Well, not even values, right? I think that like if you're desperate, you really need the money and you take it, but then the investor screws you somehow. Like you may as well have just like not take. So I'll give a really
correct, but you can't
example.
predict the future, right? And so it's like on the balance of probabilities of like, so there's always an if.
One of my friends a long time ago signed a term sheet for an investment. It was fine. They got $1 million and running the company. But when they actually went to go sell the company, and I reviewed this too, I had a look at it.
Yeah.
The investor had a 10x liquidation preference.
Yeah. And
I thought, they ended up taking all the money and the founder got nothing, even though they sold it at a premium to what they raised at. Yeah. And so... yes, one might say,
that case is definitely what that case is. Definitely
maybe he was desperate for money at the time, but
because however many years he just didn't get paid, he was just took all the risk and didn't get anything.
Yeah, and so that little sneaky clause, and to be fair, I don't think many investors are very, very small. This is probably the worst kind of investors that are doing this.
Yeah,
it's a very small percentage, but I just wanted to give you an extreme example of when it could go really badly.
And I'm finding more and more of this at the moment, actually, especially when the market's down. There are more and more of these investors that are around, and these are investors which go, I'll give you some money today and I get 50% of your company. Problem is that you become uninvestable to traditional tech investors. And there are 2 ways out of that. 1, you don't get out of it and the company fails, or 2, you restructure your company. And restructuring a company is not easy. And I've seen it go sideways this year and trying to restructure a company from a bad round.
Restructure as in buying out other investors, is that what you mean?
So say you do a pre-seed round and one investor gets 50% of your company for it. Then the next investors go, we want to give you money, but that investor can't have 50%. So you need to restructure your company and you need to scale them down from 50% down to 15%. And you as the founder need to have the rest of it. So you've got to go and have that conversation with that investor and try to convince them that this company's dead unless you give me a whole lot more of my own company. It's not an easy conversation because that's about ego and pride and principle. And the investor goes, well, I bought this fairly and squarely. And like, why doesn't everyone else have to do this? Why is it only me paying for this? Blah, blah, blah. And so there are all these things that go on and it can go sideways. So yeah, it gets very complicated. There are other investors out there that still have somewhat old school thinking around how to grow private high growth companies. And so their idea is, I'll give you money today, and then in 2 to 3 years' time, you're going to list on the ASX. That's also very problematic. Problem is, in my view, is that ASX investors don't have the tolerance for volatility and risk. And high growth tech companies are very volatile, risky operations. And it's not a linear kind of growth trajectory. Plus, they don't have the resources to really, to adhere to the governance that's required for like a listed company.
That's wild. I did not know that was a thing.
Yeah, it's very much a thing. Yeah, I've come across many of them. It's more and more at the moment. And then there are other ones who are like, I'll buy these shares off you, and then I'm going to go resell them like straight away, and like all this sort of stuff. And I'm going to resell them at double the value. And there's lots of stuff going on, left, right, and center. Those ones are more obvious and easy to find. The ones that are harder to figure out are the ones that you just talked about, where it's like sneaking terms in there that the founders really don't know about. And this is why, again, I drill into founders. You must have a highly experienced startup lawyer on your side. None of this like local lawyer like bullshit. Like they need to be one of the best startup lawyers that in the last year has done 20 to 50 startup investments. That is what you have, because they will tell you this straight away. They know what is acceptable and what is not, and they will tell you. And they pay for themselves straight away. So that's one of your ways of being able to detect this stuff, because you can't know all these tricks. It's just not, you don't do this all day, every day. So you can't know these things. And that's one of the ways that you can help reduce this risk.
100%.
Work with me.
Yeah. Work with Warwick.
Fuck, it's talking up the lawyers. Work with me too.
Yeah, you missed the plug. I think it was a bit...
Damn it. Fuck.
Didn't feel as natural there. The other thing is like just read VC Deals by Brad Feld. Like,
yeah,
venture deals.
Venture deals.
But
but like the truth is like most founders probably have ADHD or some kind of like attention deficit, and reading a Bible on financial terms is probably really fucking hard for most people, and probably not going to mean a whole lot. But yes, I agree with
most people aren't messaging their friend Warwick, like asking them to send financial like documents about how debt works and all that kind of stuff.
Yes,
so
correct.
Yeah, I get it. Okay, cool. Number 3. Raising money during a hype cycle might feel easy now, but it will set impossible expectations for the future.
No.
So the caveat here is that raising a extremely high round, raising a lot of money. Yeah, I didn't really summarize the point well, but it will set impossible expectations. So just because you can get 5 million for 50 million valuation today, just because there's a lot of hype and stuff, doesn't mean it's going to be the best thing for you, especially if your company is worth 4 million in the future and you're under liquidation preference and you just get nothing. So
and yes, I agree with this. And I mean, there were just so many examples of why this is true, like even in the last few years, just like it's crazy the amount of examples that are out there. One of the public ones is that I was listening to an interview by the founder of Discord on 20 VC the other day, and he said that they got 5 term sheets for $1 billion valuation, and they took the one for the $300 million valuation. And then they went and invited all the ones who gave them $1 billion valuation to come and participate in the $300 million round as smaller investors. And he said just because, like, I don't think it was his first company. He's like, I know the cost of taking the highest offer, but also like it's more about the firm, but more about the partner that I'll be working with. And I wanted to work with this partner, and they were the best for us, and that proves correct today. And so yeah, it's about so much more than just like getting the best deal, numbers deal, right?
Yeah, perfect story. Kind of adds to the point. So I think we can move on to the next one because there's not too much debate there. This was just, I just found this stat from Carter to support the previous point that 42% of price seed rounds in Q1 this year were bridge rounds.
Oh yeah, I mean it's been like that for years, since the highs of
2021.
Yeah. A lot of companies been surviving on bridge rounds, and that's all coming home now. And sadly, there are a lot of companies that are going into liquidation at the moment because these bridge rounds have been limping for a while, and they're all finally coming true.
So this is more about founding team, and we kind of already talked about this, but one of the hallmarks of a good founding team is the velocity they move at. So looking at where they're at, like on day 1 and then at day 30, and seeing how quickly they've gone through iterations and cycles and sort of ship things, which is why I prefer meeting a founder, watching them for a couple of months, and just kind of getting their investor updates and seeing how quickly they're moving, as opposed to, just making a leap of faith on day 1.
Yeah, and actually, this is one of the things that I coach and talk about a lot. That is very different to like popular capital raising, like kind of teachings out there. Is what most teach is that you get everything ready for a cap raise, and then you go out and talk to investors, and you're basically raising money, right? The first time you meet them, you're like, hey, nice to meet you. By the way, I'm raising $1 million, and let me know in the next couple of weeks if you're going to give me money. Problem is in pre-seed and seed, like founders are investing in investors are investing in founders, and they need to build conviction that this is the right founder, and therefore they need to build a relationship. And therefore, if you're turning up being transactional, say, nice to meet you, by the way, you have 3 weeks or 2 months to assess me and then give me money, then you're creating a transactional nature. Whereas if you turn up and say, hey, nice to meet you, by the way, we're not raising at the moment, just want to introduce ourselves, we want to get to know you, you get to know me, and then let's decide if we want to partner together in the future. And then once that relationship matures, and hopefully you matured a whole heap of other relationships at the time, then you can open a round with 3 weeks. It's like, okay, well, now I've been talking to you all for a year. You all know who I am. You've all been following our journey. I've been updating you. I'm opening the round. Here's a data room. You all have 3 weeks. Get in and get out. And let me know at the end of the 3 weeks if you're going to invest or not, or you want to give us a term sheet. That way you can run a competitive round, and that's in the best interest of the company. The other way is you're just like clutching at straws the whole time, and there's almost no way to create competitive tension, because all these relationships and conversations are maturing at different times, because everyone takes a different amount of time to build conviction. Like a family office takes a long time compared to a single angel investor, but then VCs take huge amounts of time. But the size of the VC really depends on how long that'd take as well. And it depends on what kind of money, if they're managing superannuation money, then they probably have a lot more stringent checklists and stuff that they have to go through before they can deploy money, and it takes longer and all this sort of stuff. So, I strongly discourage from trying to make it transactional. And I think, like, if you really dig into most of the stories of these really big capital raises that just turn up in the AFR and you're like, fuck, they raised all that money in like a couple of weeks. No, it's all bullshit. Like the majority of those capital raises, there are years of relationships behind those, and they don't just happen overnight. A lot of those founders have known those investors for a long time, and they're capitalizing those relationships now. So they don't just, most of them don't just happen overnight. Some of them do. Like, don't get me wrong, some of them do, but they're very rare. And I actually really want to do a study on this. For many years, I wanted to do a PhD, but I'm horrible at studying formally, so it's a bad idea. But anyway, I wanted to do a PhD on like looking into researching the relationships and the capital raising process, and seeing like really what's behind these capital raises, because I've been on many of them, and I know, right? But it feels like anecdotal evidence in a way.
Yeah, that would be fascinating. I'd really want to know that as well.
Yeah.
Okay, so next one. Chasing warm intros is a distraction. If your product is compelling, cold outreach can still crack the door open.
No.
No?
Nah. Warm intros is like king. It's it's very, very rarely have I ever seen a cold outreach work. They are so expensive, because like if you have a well under 1% open rate, then like that's just way too expensive. And warm intros are amazing. Like getting someone to vouch for you that investor trusts and respects is like worth 6 to 12 months of relationship building. And I coach founders on like, you can't shortcut relationships. Do the work. Bad luck. Like, this is the game. You need to do the work. You need to build relationships. And if you don't have a warm intro into that investor that you want to talk to, then go and build a relationship with someone who can warm intro you. And that may take 6 to 12 months, but that's going to be far better than sending a cold email to them that they're very likely going to ignore, and you missing a shot on goal with an investor that would be ideal for your company. You can't shortcut and buy relationships. I just don't think it's possible. And this goes for paying for advisors to introduce you as well. Like, I just don't believe that paying advisors is a good move, and most of these advisors aren't respected by the investors, and it's actually like a negative if you're getting an introduction from an advisor, because it's like, hey, you're trying to shortcut the system. You're trying to cheat the system by paying for it. We know that this advisor is a pain in the ass. We know that he sells an introduction to us. I've met him like twice. I don't actually respect him, and you've just gone and hitched your wagon to this guy. It's not a good move. Do the work. Do the hard work. Thoughts?
Yeah, so, I mean, anecdotal, like, I guess from my own experience, I've only ever fundraised from warm introductions. I haven't actually got any money from cold outreaches, but I've been able to get a lot of meetings through cold outreaches. So when I went to San Francisco, I didn't know anyone. Just hit the pavement on LinkedIn, started sending messages to people, and like maybe had like a 30% hit rate, but still good enough to secure a bunch of meetings. And it didn't end up in any money. So potentially I can't make a definitive statement that like, yes, cold outreach is still available and still can work. But I think people are willing to have conversations if you have something interesting to show them, at the very least.
But and just don't expect them to invest in the next 6 months. Expect them to invest in the next few years if you get through to them.
Yeah. So I think cracking
once.
the door open still holds true. Like, you can still crack the door open. Just don't expect to like
I'll give you that small win then if you want.
Yeah.
So I've been successful in a capital raise once where I sent out cold emails when I first started capital raising for a company at the very start of my capital raising journey, and I did very targeted, very deep research, outreach. And so I'd spend half an hour at least researching each partner, crafting a message that would resonate with them and all this sort of stuff. And one of them did reply, and this person who replied was extremely senior at one of the largest VC firms in the world. And he's an very high up in the federal government as well, with a huge amount of influence. And he took a meeting, and then that relationship for that company continues today, and hopefully one day they will raise off the back of that relationship.
Nice. Is that how you met Mark Andreessen? That's awesome.
Yeah, no, it wasn't A16Z, but it was very close. And so, yeah, it can work, but that's anecdotal evidence, and I don't think that the juice is worth a squeeze, because I had to send out another 200 emails, which, half an hour to an hour researching each of those at least, and only one of those actually eventuated. That's not a very good return.
Yeah. Okay. So warm intro is still king, but I still think that if you craft the message right, I treated it like a growth hacker. I thought about the hook.
Yeah.
What's the viral hook going to be when I send the message? Where are they going to check most likely?
Yeah.
There are fun ways to do this, and I think you can stand out if you do it correctly. For example, I saw a YouTuber who wanted Alex Hormozy to invest in his company, so he made a TikTok video of making a parody of the Dollar Shave Club ad, if you remember that.
Yeah.
So it just did that, got his attention, and then managed to get the meeting, right? So,
but that's not cold outreach. So I also employ this strategy. This strategy is inbound investor interest is far better, right? So what I've done a few times is we create very targeted, very specific media to target certain investors. So it's hey, maybe we go and do a whole stint on certain podcasts that we think that these investors will be listening to. We deliberately target, go to certain events with certain messages and certain LinkedIn things and all this sort of stuff, very targeted, and it does work. Again, it takes time, but you do also get all these unintended upsides of it, that all these other investors see this, right? And so all of a sudden, other investors start coming through that you never thought that would be interested. And again, that's investing in PR, especially if you're a high growth company where you need to find first believers and that sort of stuff. If you can do an inbound strategy, it can be very effective.
Okay, so new takeaway is warm intros are king, but if you can't get that, be creative. Basically.
Fuck yeah. I coach founders all the time. I'm hey, you want to get in front of this billionaire? Find out what causes they care about and turn up to the fundraisers that they're at, and give money to whatever charity it is, and turn up and get in front of them. Get creative. This shit. It's not you can get so creative, and with ChatGPT, you can use ChatGPT to help you figure out how to get in front of each person in a creative way. You used to have to do that with someone else or whatever, and it was really hard, but now you don't.
Okay, so I don't know if this will offend some investors, but I think smart money is actually just staying out of the way and making your network available. And that's basically it. I have not actually found help beyond that, because they're not going to be day to day in the business or anything.
Yeah.
If they don't bug you and they just anytime you're can I get an intro to this, and they're yep, done, that's basically the smartest possible money I think that's available. That's my take so far.
Yeah. So this smart money, dumb money thing is a term that gets used all throughout what's called the capital markets industry, the finance industry, which is, capital markets is raising capital for companies. We used to use it when I was at ANZ, and dumb money referred to quick money. Quick money referred to hedge funds and day traders and that sort of stuff. So they'd buy a bond that we would sell, and then they would dump it almost straight away. And so it would damage the value of whatever you're selling. The term here usually smart money and dumb money is used by founders to signal strategic value, insights, networks, that sort of stuff. Look, I'm not a founder of a $1 billion company, and so I can't really talk to this. I know what a lot of people say and what is out there, and I've listened to other founders talk about this a lot, and other investors. I actually was listening to an interview from Nick Crocker 2 days ago on the Startup Podcast, and he stated that he thinks that most investors, pretty sure it was him, most investors don't add any value or do erode value. He said the way to combat that is to do reference checks and due diligence on investors. It's very hard for these investors to add any genuine value because they are not in the business all day, every day, and they have many other companies and things to worry about. And yeah, so I think one of the biggest problems is investors don't know how, is founders don't know how to utilize investors properly, and they're not good at asking for help. And I find that all the time. I think the pretty good founders, they figure that out pretty quick, and they learn to be vulnerable and asking for help. It's like, hey, like I'm struggling to get in front of this company. I need your help. Like, and like, a lot of investors are pretty well connected because of the position that they're in our society, and they can usually be kind of helpful. But
they tend to be very resourceful, right? So if you know exactly what you're asking for, then they can put you in front of the right person pretty easily.
Yes.
So I need help with this problem, and I need an introduction to this person. They can do that, right?
Yeah. And one piece of advice that I saw a couple of years ago that I really liked was, don't send out an investor newsletter going, hey, and by the way, in case anybody like knows of an introduction to like C-suite at ANZ Bank, can you like let me know? Send out your newsletter, but then like very targetedly like message each of your investors that you know or think will actually have it, and be like, hey, by the way, Ben, like I know that you like used to work in the banking sector, and like I really need this, like this is why I want it, and this is what I want, and I see that you're connected with this person, can you make it happen? That is extraordinarily different because you've gone and done the work up front rather than asking them to do all the work for you. Again,
it's like the bystander effect, right? Like when if someone's getting stabbed on the street, 100%. Everyone walks past, but if you grab them on the shoulder and be like, hey, I need your help.
100%. It's like, oh yeah, someone else will probably know someone at ANZ, so like, whatever.
That's my reaction when I look at an investor update. I'm like, yeah, someone else has got this.
And like, there's one thing that I've learned from doing sales is like, just pick up the phone and talk to them. Like your investors, just like call them. Like, don't do everything through email. Like, just call them and talk to them. It's the same in sales. Like, or when you're having troubles with like colleagues or whatever, it's like just have a chat in person or over the phone. Like because you get you hear like the emotions and all these sorts of things, and all of a sudden like it becomes more real and becomes something you can action. But also a lot of people are hesitant to tell you the real reasons why they say no over like on email or somewhere that's recorded, but they're happy to usually tell you over the phone.
Cool. Number 7, we already talked about, so I think I'm just gonna skip this one. Number 8, I'm curious to hear your thoughts on this, but I've come to the realization that VC is not a great investment. And this is the graph that I have to back it up. This is the internal rate of return of different funds from 2017 vintage to 2022 vintage. How many of them are under 0, between 0 and 9%, and then so on and so forth. So like first you have to pick the right fund that's going to make you this return, and then secondly, you don't have any liquidity for like a significant period of time. And so I think I've come to the realization that I would prefer making 5 to 12% on stocks or like public assets, or even just put it in Bitcoin or something and just keep the liquidity available to me as much as possible.
Spoken like a true optimist and founder. It's like,
Okay. Any thoughts on whether VC is a good investment?
past performance does equal future performance. The last 5 years has been really good in equities. Therefore, I'm going to put everything in equities. Can you tell that I was like formally educated in like portfolio construction?
No, I had no idea. I'm like surprised.
So I studied finance and banking and accounting for many years, and obviously worked in the sector for a long time. Look, it comes back to like who you are and what your motives are and what you want to get out of it. If you're in it for financial reasons, then generally what is said is you should have under 5%, 5%-ish, whatever, depending on your risk appetite, maybe up to 10% in private equity, illiquid investments, that sort of stuff. And if you have really high risk appetite, then even more. It's not necessarily about putting all your money in VC and going, great, I'm going to get a 25% return. Like, that's not how you look at investing in general. You look at investing in general around a risk return spectrum. And so you're effectively trying to optimize for getting the best return for the level of risk that you're taking. And if you're looking at it from a holistic perspective, I'm investing for the next 20 years. I have a higher risk tolerance. I'm in my 30s. I have another 30 years to earn money, and I have a mortgage that's only 3/4 of it left, right? And so I'm optimizing for capital growth and also and high growth. So then I can retire in a happier way, right? It's a very different proposition to I'm a billionaire and I'm super high risk. I've made my money. I've got lots of money, and I like taking bets, and I like talking to my friends about the billion-dollar companies I've invested in and the access to the founders that I have. They're very different. So when I talk about this with anybody, it's more about, hey, like, what do you want to get out of it? What's your risk appetite? What does good returns look like for you? And then are we looking at this as a holistic portfolio approach? Because actually tech, like some other investments, can be like cyclical, counter-cyclical. What kind of risks are you trying to address in your portfolio? Are you over-indexed on certain types of companies or certain types of risks, and therefore, tech balances that out, blah, blah, blah. And so you're looking at it more from that perspective. If you're talking about just investing in VC, 100% of your portfolio in VC, then that's a very different story. And it's good to look at asset classes like individually, right? Like, does this make sense? But I don't think you can look at them in isolation. And for a long time, I've seen a lot of venture capital raises over the years, especially only in Australia, almost exclusively in Australia. And it's very interesting, the people that allocate money to venture capital. Usually they're allocating money to venture capital not purely for financial reasons, but more for other reasons. And I think it's a function of a few things, but I think mostly because the people who start and run venture capital funds are innately extremely good storytellers. Because, do you know why I have to be a good storyteller? Because you give me money today, and I'll tell you in 10 years if I'm right. And by the way, past performance does not equal future performance. And I saw a stat the other day that, I don't know, it's tiny, under 0.5% or 1% of all venture capital funds in the world have ever had 3 consecutive funds perform in top tier. And so if that's the number, like,
Wait, what position are you taking now? I don't even know if you're like sort of convinced me and then sort of not convinced me, and like now I'm scared.
well, the answer
Regardless.
is it depends, right? And so I think that the people who run these funds are very good at telling stories, and the people who come along on these journeys are, they like stories, and they get a motive with these stories, and they invest based on the story because they're investing in outliers. And a lot of this game is kind of random and unpredictable. And so therefore, if there's no way of going, hey, like I have a theory and I can kind of prove it out to you, and in the next, you know, and you can give me more and more money over the next period of time to like prove it out, that like I think in the next year it's best to like invest in AI and it's going to give us all the returns. That doesn't exist. It's not like a debt fund where you can just like pay out like coupons, you know, every quarter or every 6 months or every year, and like you kind of know where things are going because there's daily repricing and all this sort of stuff. That doesn't exist. So therefore,
there's
to make
crypto
the
prediction
jump,
markets where we get to start making bets. Yeah.
yes, but to make the jump, right? Like for investors to make the jump, they have to basically believe the story, because there's nothing else that these investors really have other than the story, and getting people to believe that for some reason they're the people that are going to make their money. They're going to 3-5x their money. It's the same as a founder, right? It's like founders are the same. It's like you just have to take a leap of faith that in 10 years' time, this company is going to be worth 10 billion bucks, and I only have a tiny little bit of data, and that can't predict the future. But you just got to take the leap of faith and come along for the journey, right? And the truth is that most of them significantly underperform equity markets, right? But investing solely in equity markets, if you're looking for balanced returns and like a good healthy portfolio, doesn't make sense. So my answer is it depends.
That's a good answer. I like it. I think I'm probably also just salty because I started investing in venture in 2021, and you can see what the graph looks like for that. So
Yeah.
you know, it's just me, my personal vendetta against VC.
Yeah. Well, so I said to my dad in the GFC, I'm like, oh, Dad, are you going to sell all your equities? Like, oh my God, the world's falling apart. And he goes, no, why would I? And he's like, not stressed at all. It's like, why would I? I'm like, well, because look, the market's down like 40%. This is like insane. He goes, well, I invest in over 20-year horizons. I've seen 3 of these already. I'm going to see probably another 3 to 5 of these in my lifetime. He's like, I'm not investing for today. And I'm not in a position where I have to sell. And I'm pretty sure in 10 years' time, like things are going to be fine. This portfolio is going to be significantly larger than it is now. And so therefore, like it is what it is, right?
That's a good point. I think, see, with crypto, I've gone through 3 cycles now. So I've seen it go up and down. So I feel more confident that I know, like, even if it goes down, it'll come back up again at some point. And I'm thinking more long term. Whereas VC, with my 3 years of experience, I'm already panicking. So I think that's a good point.
But you're investing for 10 years, right? And actually, I saw some data a couple of years ago which showed that like portfolios that showed a higher IRR in the first like 3 to 5 years actually end up like significantly underperforming, and those that show a lower IRR in the first 3 to 5 years generally ended up outperforming, because the majority of the value is created in the last 7 to 10 years of that investment. And so therefore trying to use short-term IRR increases to predict a 10-year investment is actually like a fool's game.
Nice. So I'm going to be rich. I appreciate that. I'm going to hold you to it in 7 years.
I need to find this. I don't think I told you. I tried to start a data-driven VC 2 years ago. And so I basically spent an entire year digging really deep into into studies and the mathematics of venture capital, and trying to find ways to like arb and fuck with like the power law and outliers and all this sort of stuff, and like predict them. In the end, I gave up because I don't think it's possible with what we have today. I think the majority of VC firms' performance is luck, especially because a lot of the VCs believe in concentrated portfolios. So they, rather than investing in 50 or 100 companies, they prefer to do like 10 or 20 and just like go all in on them. And so therefore the returns will be astronomically higher if they get it right, but if they don't, then it's zero. But they would prefer that than to have a more median return, because the median is not impressive for venture capital.
Well, also, like, if you're going to play the VC game, like, that's how you're going to play it.
It's all risk, baby. Go all in. Exactly.
Why invest if you're not going to go for all the
early stage VC? Early stage VC.
Yeah. For equity is like, you can keep your standard stuff in the equity portfolio. It's fine. Okay. This has gone a lot longer than I expected, and I feel like we could probably go for another hour if you wanted to. Because I like talking about this. So I'll make the quick 2 points. 2023 to 2024 VC wasn't bad. It was just back to normal. And this is
Don't believe it. Nah. And Australia is fucking horrendous. I just did the numbers on... I just did the numbers. And,
this is US, by the way. So if you're looking at the graph, just before you start your point, it was sort of at a level, it peaked in 2021, and now it's back to what it was in 2020, 2019, 2018. So that's why I was sort of like, okay, has it really died, or is it just like come back to normal?
Yeah. So in the areas that I work in, especially like deep tech, that sort of stuff, some of the areas like MedTech, I'm actually started writing a report called Who's Really Funding MedTech in Australia, where for the first time ever, I'm like going deep into every single investment that's being done in Australia, and figuring out if it's a grant, if it's private money, if it's like whatever, and figuring out who's really funding MedTech. And I can tell you the numbers are like they are fucked. And we have a big issue. This year, the amount of money that went into MedTech was, let me see, it was 3.5% of the amount of money that went in the year before.
Wow. Oh my God. Okay, but to play devil's advocate, did it reallocate into a different space, or just funding in general?
Don't know yet. I guess we'll find out from. But like, look, the market's down significantly, and it's no secret that there's a lot of turnover in VC at the moment. There's a lot of funds that have gone into like zombie kind of dormancy. The market's contracted significantly. So I mean, that's no secret, and it'll be interesting to see the numbers once they come out through, what's it called, cut through venture. I'm just focusing on MedTech for now, and then we'll do other deep tech sectors over probably next year. But yeah, there's significant problems.
Okay, makes sense. And then final point: solo founders versus co-founders makes no difference, as there's pros and cons to both. And to give more color to this opinion, I think if you asked me a few years ago, I would have said solo founder all the way, because co-founders is just like another vector of failure, and like, why would you introduce that as a potential reason of failure? Like, if you argue with the co-founders, all that kind of stuff, I just don't want that. And if I didn't need a co-founder, like, why should I bring one on board? And I remember one of the investors, when I was first raising the first round, he was like, why don't you have a co-founder? And I kind of snapped back with like, what do you think I'm missing? Like, what do I need?
I'm the whole package, baby.
Yeah, it was probably a pretty cocky answer, but like,
whatever.
That was what I thought, right?
Yeah.
And but I think after 4 years of being a solo founder, my thinking is now, but with co-founders, you can share a lot of the pain and the difficulties, and there's a level of like trust and teamwork and camaraderie that comes with a co-founder that you just can't get with your employees, because they still might quit, right? Like, it's really hard for you to like really open up and be honest with them. Whereas a co-founder, I think that so for context of my next business, I think I will take a co-founder. I'm 90% sure I will, just because I think it's more fun. You share some of the pain and you can go further together, basically, is my thinking. So I
That's
think
very
because there's
kind
pros
of
and cons
you.
to both, I don't think that a VC should be looking at a team and being like, oh, there's a solo founder, they should have a co-founder, or co-founders, they should be solo. That's my uninformed opinion based on just anecdotal and personal experience.
Yeah. If anyone's interested, read the book called Super Founders. It's basically an analytical book about stats behind successful founders. I'm pretty sure there's no difference from an evidence-based perspective. One thing that I am starting to advocate more for is that founders, co-founders, people who have more than one founder, but even if you're a solo founder, one, you have a psychologist and you're always seeing a psychologist personally. Two, you have a couples counselor and you as the co-founders actually go and see a couples counselor, and they will teach you how to have difficult conversations, and they'll help you navigate these sorts of things, because that's what they do every day. Because you're under such significant stress and pressure for significant prolonged periods of time, and it's very easy to avoid painful topics because it's too hard and you're not equipped with the skills to have these conversations. Problem is that manifests into bigger problems. And I know this because like going couples counsel with my partner, and like it was just such an unlock when we just went in there and like, oh, so this is how we can have this conversation. And all of a sudden, like we just started communicating so much clearer. And I'm sitting there, I'm going, of course, like this person all day, every day, they specialize in helping people communicate. And they do this, like they probably have 20 clients at any one time where they're like, and they get to practice this for years, right? They may see hundreds of people this year, and they've probably seen thousands across their career. And I'm trying to like figure this out trial by error, like by myself at home. And we're getting more and more angry at each other. And then we could have just gone and paid $150, $200 for this person who specializes in this, who sees these same conversations thousands of times a year. Like, what the fuck am I doing? What like it's such an unlock where it's like all of a sudden these things that cause stress, like just shouldn't be. And there are such easy ways to like unlock them and get things moving and relieve these pressures in your life. And it's like, for some reason, where we think it's bad. We think it's like I don't know, like we're supposed to be born naturally knowing how to have really hard, complex conversations with anybody that we interact with. And everybody's different, and everybody has their own experiences and trauma and all this sort of stuff. Yet for some reason, we're born thinking that we just have to innately know this and we shouldn't ask for any help. And it's like, it's just so stupid. And this is the biggest unlock in the last year and a half for me in my life, just like learning that, like seeing psychologists and like an executive coach and a personal psychologist and a couples counselor and an ADHD coach, like fucking hell, like I am like 10x where I was a year ago. Just don't have to try to figure this stuff out myself. It's I'm not the first person in the world to face these problems, and like great, there are people who specialize in helping you with it. So yeah, that's my opinion of it. It's yeah.
That's a great point. I like that. Any final advice or thoughts to someone who's listening and thinking about fundraising?
Don't be afraid to be vulnerable and be visionary and have a bold vision for the future, and don't try to please everybody. You'll end up mediocre. Just be who you are. State your belief about the world if everything goes right, and back it, and you'll find that like people respect authenticity, and people who are vulnerable much more over people who are trying to sit on the fence and please everybody. I've learned that personally myself. Just like you've probably seen my LinkedIn content this year, like and what I've been saying in this interview today is the product of the last few years of like freeing myself from trying to avoid rejection and hurt and all these sorts of things, and just being authentic and going, this is who I am, this is what I believe, and not everybody has to believe in it, and not everybody has to be my friend. I don't have to be friends with everybody, and that's okay, because there's like 8 billion people in the world, and like we don't all have to like see eye to eye on everything. And now I actually like talking to Trump supporters, and I'm not a Trump supporter, and I don't really like Trump, but I like talking to them because they challenge me, and I get to have interest in engaging conversations rather than trying to shut down anyone who has a different opinion to me. And now I value it over before. I used to be like, oh, get out of my way. I don't want to, like, it's like, whatever. Like, actually, this is our democracy in action, and it should be respected and enjoyed, and everybody should have different opinions. That's the beauty of the world that we live in. Imagine if we all fucking thought the same way. Like, how fucking boring would that be?
Yeah. Would make things a bit easier though.
But if it was but if it was easier, then we wouldn't have innovated. We wouldn't be where we are today, would we?
Yeah. Sorry, I don't know why I decided to take that stance for no reason.
I like that. It's fine, because it's the truth. It's like, yeah, but wouldn't it be nice just not to fight and not to argue and not to have tension all the time? Yeah, it would be. But through constraint is the mother of innovation, right? And this tension is what keeps us progressing forward.
Yeah. Awesome. I really appreciate the time. I actually had a lot of fun. This is like one of the more fun conversations I've had all week, so I appreciate this.
Yeah, I really enjoyed it too.
If you are listening, check out Warwick's stuff. Check him out on LinkedIn. I think that's your main...
Check out my stuff! Yeah,
LinkedIn website, what do you want to plug?
Yeah, LinkedIn, and I have a newsletter called the Aussie Startup Capital Nerd, where I publish like free insights and tips and tricks for Australian founders on capital raising.
So do that, because you've taken up, like, we've spent 90 minutes of our time to give out free values. So if you want to pay us back, you don't have to give us any money. Just go subscribe to the newsletter, go to Warwick's LinkedIn, follow him. And more importantly, go to our YouTube and Spotify and like subscribe or follow us there and leave a comment. And if you leave a comment, let's say your fundraising hot take, I'll pick the most interesting one and I'll pay you $100 US. So just write down your hot take for fundraising. Maybe I'll get Warwick to pick. We'll see how we go. And I'll pay you guys a gift card or something like that. We'll figure out how to get the money to you. But yeah, we're going to do a giveaway based on what your most interesting hot take is. And you can't pick any of the 10 I have. You're going to come up with something completely new.
Yeah, and what's most interesting to me is people who don't agree with me. I'm one opinion in this fucking world, and I've had a very certain, like, I've had a set of experiences and like, mindset and characteristics and all this sort of stuff that shape and I love people who are like, that's not the way that I see the world or this problem or whatever. And that is what makes me better at what I do, but also brings value to everybody. So if you don't agree with anything I've said, like, fucking, like, let us have it. Like, it's super interesting because my experiences are my experiences, and they're not shared around the world.
Yeah, let us have it. And for roasting us, you may just get paid. So, win-win, I think. Catch you guys later.